Good morning, everyone. My name is Bruce Lynn. I'm one of the managing partners of the Financial Executives Consulting Group. We're going to start the main body of our presentation in just a few moments. I want to give everyone a chance to log on. For those of you who have logged on, a couple of administrative announcements. You are in mute-only mode, which means that you can hear me, but I can't hear you. If you have questions during the presentation, please type them into the question box on the lower right-hand side of your screen, and we'll get to them after the main body of the presentation. If you don't want me to read your questions out loud, you can send me an email afterwards, and we can take them offline. And of course, if we run out of time, not to worry, your questions are up in the cloud, so we will again get to them offline. This is being recorded, so if you have to leave early, you don't want to miss the ending and the Q&A part. So you will get a copy of the recording and you can listen to it at your leisure. So now I'm going to go away here for about 60, 90 seconds, and we're going to start in the next minute and a half and 2 minutes. All right, good morning, everyone. For those of you who have just joined, my name is Bruce Lynn. I'm one of the managing partners of the Financial Executives Consulting Group. Today, we're going to talk about thinking about selling in 2024. The time is now. We have on the, as a presenter today, Ramsey Goodrich from Carter, Morse and Goodrich, who'll talk a little bit about the challenges that people face when looking to really think about the value of their companies. For those of you who have just joined, you are in mute-only mode, which means that you can hear me, but I can't hear you. If you have questions to Ramsey, please type them into the question box on the lower right-hand side of your screen, and we'll get to them after the main body of the presentation. If you don't want me to read your questions out loud, you can email me later, and of course, we'll take it offline. Or if we run out of time, again, we'll take your questions offline since they're already typed in. This session is being recorded, so if you have to leave early, you can listen to the entire presentation at your leisure. So with those announcements out of the way, let me introduce you to Ramsey Goodrich. And Ramsey, why don't you fill people in with a little bit more about you and Carter, Morse and Goodrich?
I'd be happy to. Thank you so much, Bruce. And thanks everybody for joining us today. We think this is one of the most important aspects of being successful when you're considering options for companies. The planning and preparation is so critical. So we appreciate you taking the time today. And we've got a full packed agenda for this morning. So going to try to get through this as quickly as possible. But as Bruce said, if there's any questions or follow-ups, certainly get in touch with Bruce, who will get in touch with us, and we'd be happy to continue the dialogue and be helpful in any way we can. So appreciate it. So let's just dive right in. As Bruce mentioned, Carter Morse, we are a boutique investment bank based in Southport, Connecticut, where we specialize in advising almost exclusively families and founders through their once-in-a-lifetime transaction. Looking at some of the demographics, mainly families and founders, you can see about 80% of that. In that $50 to $150 million range is our real core target. And because we're family focused, our target industries tend to be old economy businesses, manufacturing, industrial, business services, and consumer. So what a lot of the stuff we'll talk about today is mainly focused for those industries. Those in healthcare, technology, fintech. Themes are still applicable, but maybe the outcome might be a little bit different. We are primarily sell side and sort of agnostic as to the type of process we run and where the outcome really ends up. A little bit more about us, as we said, trusted M&A advisory for families and founders pursuing their once-in-a-lifetime transaction, primarily focused in the Northeast, but we're really looking for motivated owners who value great advice, appreciate great outcomes, and where value means more than money. And so what that means is some of the dynamics that get into play for an M&A transaction tend to be a little bit different than those driven by, let's say, private equity or corporate sellers. So we close lots of transactions with pretty tombstones and win a bunch of awards. And you don't see on here one was announced today, which is our 2023 M&A Advisor International Deal of the Year, over $100 million for a recent transaction we closed in the HVAC space. So. And we happen to have really cool offices. Believe it or not, that office in the middle of the river there is our office. I wish I was there today, but traveling a little bit today. But I thought we'd start off with a little bit of the state of the markets and where we are at the moment. Right now, you can see here the effect of COVID right in the middle there certainly put most of M&A to a screeching halt. But it rebounded quickly and hard, especially through 2021. The first half of 2022 was quite robust and continuing the trends of 2021, where it was a feverish market, both buy side and sell side, with folks really trying to get ahead of some pending economic news. In the second half of 22, everyone seemed to come back from summer vacation from their house in Nantucket, and then all of a sudden realized, oh my God, what's really happening here with interest rates, with retracting debt markets, and a lot of new M&A came to a screeching halt. The deals that happened in Q4, Q1, and even into Q2 of this year were really hangovers from last summer, believe it or not, where the processes took longer and really getting going. We'll talk a little bit more about that in a moment. But you can see we've been in a declining market from the feverish pace of 21. However, if you look more historically, it's still on par with, especially in the middle market, it tends to be less volatile than the upper or mega markets. So valuations, again, 2021 was really, really strong, one of the best years we've ever seen. 22, 23, back to reality. Again, not bad from a historical perspective, but there's no polite way to say this, but you missed the peak. The peak was definitely in Q4 of 21. And it's much more rational now. We'll get into where we're talking about things in a little bit. But I think it's also important, if you look at those two slides on the bottom, it really depends on a lot of different aspects. You can generalize the market this way, but by the time you get into it, you also have to look at the type of buyer and the size of those transactions. Bigger companies are worth more. Because they can absorb risk, they can absorb a hiccup, they probably have better systems, better management, better growth prospects than some of the smaller, riskier type of investments. So if you look at by buyer type, you'll see some differences there, and certainly by size, if you look at enterprise value to EBITDA, that also has a real factor on valuation. So please, as you're advising friends and families as they're thinking about doing their M&A transaction, the right answer is it depends. So you can generalize the market, but you have to get into some of the specifics. Again, something we'll talk about. The middle market, especially M&A in the middle market, is really driven by debt availability more than just about anything else. And if you look here, this is sort of the last couple of years of institutional loan volume really backing M&A. And you can see in 2019, 20, in the effects of COVID, 21 was robust in terms of the volume of transactions on the left-hand side that were actually happening, whether it be corporate M&A, private equity, LBO, private equity investments, or LBOs, really leveraged buyouts. If you look here at the Q3 of 22 and into 23, you'll see that it's all but stopped. That volume of availability really dried up quite quickly in the third quarter of 22. And you say, well, why is that? You look at the right-hand side, interest rates have gone up. the spread between SOFR and it has been relatively constant. It's not that bad, but the base rate of SOFR has really gone up quite a lot. So that all-in yield has basically doubled from about 5% to almost 10%. That cost of capital is a reflection of the perceived risk going forward. But what's really interesting is if you look at the world, it's not the cost of that debt that actually matters. This is one of the grand revelations that comes out every cycle. It's less about the cost of that debt, but more about the availability of that debt as it pertains to driving M&A and the availability of buyers and sellers. And you say, well, why is that? Let's take a really basic example. Let's assume a $50 million business with 10% margin, so $5 million of EBITDA, valued at, call it 6 times. If you look at the left column, that's what we're looking at, 50 million with 5 million of EBITDA, valued at 6 times, really basic, $30 million enterprise value. Most M&A in the middle market, privately held, family founder-led businesses in old economy businesses are driven by, roughly speaking, a 50-50 debt to equity ratio. So if you look at that, I can borrow prudently about 3 times debt, 3 times EBITDA. So if I have 5 million of EBITDA, I own and I can borrow 3 times that. It means I can borrow 15 million. If I'm an equity investor or even a corporate sponsor, I'm going to be looking at about $15 million of equity. Now, how do I make money? Really a few different ways, but the base model, let's just say the business as usual. Before I look at synergies, before I look at growth, before I look at improvement, there's 2 ways I make money. One is growth. And if you look at that top line, that goes from about 50 million to when I expect to exit in about 5 years from now, at about 80 million, which means my EBITDA goes from 5 million to about 8 million. My overall enterprise value, that line sort of at the bottom, goes from about 30 million to almost $48 million. So I've added quite a lot of value just by letting the company grow. So that 30 million is now 48. That's one way to make money, is grow the company, probably the most important way. The other way that investors make money is to pay down debt over time. So if we take that $5 million of EBITDA, tax affected, look at free cash flow, and pay that off over 5 years, now that debt line, second from the bottom, goes from 15 million to 0. So my return on equity goes from 15 to 48. That's assuming a 3 times leverage ratio. In 2021, and just about going into every major cycle, that I could probably borrow a little bit more. I can push my lenders to borrow more. So let's say 4 times. So if you look at the circle on the right, that's sort of where we were. And so using the example above at 50-50 debt to equity, 3 times debt, now I can make about 26% on my as an IRR, or a multiple of invested capital, MOIC, of about 3 times my money. That's a pretty good investment. But if I can borrow more, which is what really driving M&A, especially in 2021, I'm now all of a sudden with the exact same company, without changing any assumptions, all I've done is borrowed a little bit more at the outset, which is then paid off over time. Now, instead of making 25%, I'm making 37%. Instead of making 3 times my money, I'm making 4.5 times my money, just by that availability of leverage up front. That is, for all intents and purposes, the private equity model. However, today is what we're really talking about. That availability, as you saw from the prior chart, has really dried up. So I can't borrow 4 times. And frankly, right now, it's really hard to borrow 3 times. So we're really looking, using the example of 2 times leverage, the circle on the left. Now, all of a sudden, I'm making less than 20% IRR on my equity investment and less than 2 times on my all-in return over 5 years. That's not enough for equity investors or corporate strategic buyers to really get their board of directors or their limited partners all that excited. So that's really put the halt on leverage buyouts and middle market M&A. When that debt availability comes back to the marketplace, now all of a sudden we can get back to 3 times and eventually get back to 3.5, maybe even 4 times. That will spur a new wave of M&A. In talking with all of our senior lenders and middle market private capital folks, there's certainly an impetus to get that. Now that we've found stability in the marketplace, i.e. interest rates aren't expected to go up too much further. This is about a historical norm of where we should be. Pending economic issues are starting to resolve themselves. A little bit more clarity and stability in the marketplace has certainly come. I think you're going to start to see debt opening up back again in Q4 and into Q1 of next year. Your pessimistic lenders are going to say Q2. Your optimistic private equity guys are going to say Q3 of this year. Somewhere in that range, we expect debt markets to open back up, and therefore M&A to really pick up quite robustly as we think about what comes next. So, but it's not the cost of capital that matters. It's the availability that drives equity returns. So there we go. So what's really happening? Let's take a look at the private equity world, because that's really driving the middle market, lower middle markets. So if you look at 21 and 22, you can see those were absolute peak activity. The deal on the left is the buy side activity, US deals, and the number of transactions and the value of transactions of buying good companies because of that availability of debt. On the right-hand side is exits. So you can see everyone ran for the hills in 2021 to take advantage of high valuations, high debt availability, and a robust M&A market. I don't think we'll ever see that market again. I'd love to be wrong, but I don't think it will be that feverish pitch at any time soon. Yeah, but you can see since availability dried up in the middle of 22 and into 23, deal flow has really dramatically stopped. What that means, however, is there's a huge equity overhang. The bottom chart is the amount of capital still available residing already in private equity funds by vintage year. And you can see there's a lot of capital ready, willing, and able to be put to work as soon as debt availability comes back to the marketplace. That's all well and good from a market perspective. What's happening right now? Well, we just came back from 2 major conferences. One was Deal Max, ACG, out in Las Vegas, and the other one was ACA, our International Alliance of Corporate Advisors. And both groups are saying the same thing. The markets have paused. We see a recovery coming in Q3, Q4, into Q1 next year. And so now is the time to really prepare for the markets. Right now, the way to think about your company, again, it depends, but A quality companies, those that have strong management, great systems, good reporting, good recurring revenue, those are highly sought after right now. And there's a real premium for those that can come to market taking advantage of a supply and demand imbalance. Right now, there's almost no supply of sellers. There's still huge demand from equity investors and corporate buyers. And so there will be this supply and demand imbalance where valuations for A quality companies are still quite strong because there's not a lot of them. If you're a B quality company, you're good, not great, solid operatings, good margins, probably some low-hanging fruit to take advantage. You're still probably pretty good. And again, supply and demand will help valuation, but it's going to be harder to finance. And there's a little hesitation until we have more. While we have stability in the markets today, we don't quite yet have confidence. Once that confidence comes back, Q4, Q1, then I think B quality companies can start to come out and get ahead of the curve. However, if you're a C quality company, if you've got some operational challenges, it's harder to borrow, you don't really have the systems or management teams in place, our strong recommendation is to wait. It's not the right time to come out right now because of the hard time to finance deals where it might be available from corporate investors, but the private equity guys are less interested in taking those on right now. They would rather spend their time and keep their powder dry for a pending wave of companies coming to market early part of next year. So our general recommendations for any company today is don't rush to market if you don't have to. Mid-market M&A, especially for families and founders, are driven by personal objectives, not by timing of the markets. So if you can hold on until for a little while, our recommendation is you do until that confidence comes back. Use this time, however, the second half of this year, to really plan and prepare and get ready for a transaction process. That means trust and estates planning. That means upgrading financials, like getting the data room ready. Take advantage of low-hanging fruit. If you know something's wrong, go fix it now. If you have an environmental issue, get ahead of it. Really plan for a transaction in the early part of next year, or even Q4 of this year. So if we look at a little bit longer, that's a very immediate, very short-term, sort of 6 to 12 months from now. But if we look at the longer-term picture of markets, the typical stock market, if you go back all the way to when we were founded, 1987, you can see that there was a big crash of 87. I think we all lived through that. It was pretty painful for a few days, and it took us a while to get out. But if you look 6, 7 years later, there was a real estate bubble of 93. 6 years later, 93 plus 7 was 2000, 2001. Guess what? There's the dot-com bubble. That brought us back down to earth for a little while. 6 years later, after 2001, happened to be 2007, 2008, the credit crisis. That flushed out a whole lot of folks. Now, and you look, it took us a couple of years to get out of that, right? So plus 6 more years, you're looking at 2016 and the Great Recovery. Does anybody remember what happened in 2016? That's right, nothing happened in 2016. If you look at the chart, we took a small little pause, but nothing really happened. And so now, since then, the next 6 years puts us at 2022, which is exactly the timing that a cycle should have appeared. We probably could have, would have, should have known that this was coming. But COVID actually didn't affect this at all. So that was just a momentary blip and then recovery. So if you look at it, business owners have had a good 12-year run here through without the usual turnover of M&A transactions driven by economic and stock market cycles. And so we anticipate coming up here a really big wave of sellers that are coming to market based on a 12-year cycle, not the typical 6 years, based on surviving COVID, which really took a shock to the system and really made people wonder. And now I think we're seeing a really robust market going into 24, where I think this cycle will perpetuate itself, and we're going to see a lot of folks coming to the marketplace. So let's talk about what drives valuation here and how do you really get ready for your transaction. Given those cycles, this is what we're hearing from sellers right now. I don't want to work anymore. Work's really hard. I just survived COVID. It's no fun. It's harder. Regulations, supply chain issues, employee issues. It's really hard. It's not as much fun as it used to be. Number one. Number two, I don't have to work. Going back, you got 12-year run here. I've got more money than I can really spend. I'm good. Just monetize it and let's see if we can move on. And I want to focus my time elsewhere. I'm now 12 years older than when I thought I was going to sell. And this is an actual quote from an actual client who said, believe it or not, I actually like my wife and I want to spend more time with her while I can. So I want to focus elsewhere. My priorities are here. And most importantly, from our business, I don't have anybody to take it over. My kids really don't want the business because they've become doctors and lawyers and Indian chiefs, and they don't want to come back to our manufacturing business. What's interesting, that's really driving M&A and the motivation behind it. What we don't hear from business owners is interest rate concern, inflation concern, stock market, investment, global issues. So it's all driven, the middle market especially, is all driven by the personal state of mind of owners at the moment. So before you can launch into any transaction process, you've got to look at the options, and there are a lot of them. Most business owners think about a bifurcated or a binary option. Either I control 100% and I own 100% and I do everything, or I'm out. And that's not necessarily true. There's a lot of gray in between those two extremes. And it depends, again, on those personal objectives, but also what the strategic plan on the business is. I want to stay for the next phase, but my kids don't want to do it. I'd like to transition. Well, perhaps maybe a private equity investor makes sense. I'm really excited about the next 10 years, but I don't have the resources to do it. Well, maybe a growth investor makes sense. Or maybe I want to walk away over the next 6 months and have a smooth transition for my management team and my employees. Well, then perhaps a strategic buyer makes more sense. But it's not a binary market. There's everything in between. We try to customize each of our transactions and each of our processes to meet and hopefully exceed those expectations and objectives going into a transaction. So think about the options first. That's the key way to drive value. Is it cash on the barrelhead today? Is it rollover equity? Do I still own the majority? It really depends on the objectives. This comes out of your Corporate Finance 101 MBA, first year MBA classroom, right? The one on the left there is a quantitative analysis. You look at public markets, you look at M&A transactions, and you do a discounted cash flow. Here's why that doesn't matter. You ready? And my valuation professor at NYU would like me right now. But a discounted cash flow approach, you tell me what number you want, we can make all the assumptions come to whatever number you need, right? So that's really based on nothing but assumptions, and we can mathematically get to just about any number. Comparable public markets for the middle market doesn't matter as much. A $50 million, $100 million, $150 million business is not worth the same as a publicly traded liquid investment with strong management and systems brand name that's public, right? So while it gives a good indication, a guardrail to work from to see what's within the norm, it's really not a good proxy for mid-market M&A. And comparable transactions approach, most business sellers don't disclose what they've sold their business for, and if they do, they probably exaggerate. So the data set that you use to do that is probably fairly limited and probably less accurate than you would believe. But at least those three give us a mathematical formula to put a box around it and come up with a reasonable range of values. Overlay that then with economic outlook and some of the softer qualitative issues that we have to deal with. Operational issues, financial issues, brand, how strategic is it? What's the growth prospects? How good is management? None of which can be quantified at all. It's all qualitative, and beauty is in the eye of the beholder. And so while we think about these things and highlight these things, it's tough to quantify. You can't put a number against it. Only way you can get to a number is a really, really simple formula. You ready? Valuation is earnings times a multiple plus or minus adjustments. Earnings is always dictated by the M&A parlance of EBITDA. It's a good proxy for free cash flow, but it doesn't mean anything. And EBITDA really is what it's going to be. Yes, you look at add backs and adjustments and normalizations to try to maximize value, but it's an accounting and a financial metric that's used. So EBITDA, the multiple is where you need to focus. And how do you drive the multiple forward? And that's really hard to do, because now that you have your reasonable range of values, you've got to think about things like brand and management and growth prospects and synergies and opportunities, things that you can't quantify. But that's going to, once you have your reasonable range, how do you round up? And that's really focusing on the multiple. Once you've agreed to earnings times a multiple, now all of a sudden you've got to take a really hard look at adjustments. So in doing this for about 30 years now, I've had in a couple of hundred transactions, I've had 99.9% of the time that adjustment is negative. That means there's a surprise that comes out in due diligence, whether that be a retrade, whether it be financing markets. More importantly, it's usually a due diligence item that's popped up, an environmental issue that nobody knew about, a customer contract that wasn't as robust as we thought it might be. So the more planning and preparation you can do in advance, that's where you can minimize your adjustments. So we say plus or minus. I'm going to tell you it's usually a minus, but manageable. So here's the real question. Assume two businesses are in the same industry with the same results. Going back to the original example, $50 million business, 10% margins, $5 million of EBITDA, right? What's it worth? Well, that's a good question. It depends. So let's take a look at a couple of scenarios. What if one had highly recurring revenue versus one that's purely opportunistic? One has thousands of customers, one has one customer. I have a strong pipeline of growth and a lot of new product development and new things that are coming to market. versus I'm pretty stagnant. I don't really have that pipeline coming through. What happens if I'm really accelerating growth? You get credit for momentum. What if you're accelerating growth? What if the other one's declining? You get credit for momentum, right? So you can't look at simply a formula of what the value is worth, because it really depends on all the other factors that need to come into consideration. This is why planning and preparation now for a transaction next year can take place, because you can articulate all of this going forward. These are two slides that are really detailed. One's really detailed, one's really obvious. The one on the left is all the things you need to prove to really drive value. Is the company profitable, sustainable, defendable, scalable, transferable, manageable? Is it leverageable? Can I borrow? And most importantly, is it saleable? Is there a way that, not for this transaction, but for the next one, can I get out if I'm a private equity investor? That competition from private equity guys will drive corporate buyers to pay more if they really want the business. So that's some of the softer stuff that again, it depends, but that's really where we focus a lot of our time. If you look at it very, very high level and very holistically, value is the inverse of risk. If there's a way that I can de-risk the company by having multiple clients, by having recurring revenue, by having a strong management team, by having good infrastructure, that all increases value, right? It's so obvious, but most folks forget this. Most folks that have been driving their business and really managing their business for years, if not decades, if not generations, have a different perception of risk. Well, it's always been that way, so it's really not risky, versus somebody who's looking at it with fresh set of eyes that comes in and says, wow, that's actually quite risky. So really think about that formula as you plan and prepare for a transaction next year. This is the other one that we love. Purchase price is the very tip of the iceberg. It's the only quantifiable measurement of success. It's probably the least important. Let me say that again. Purchase price is probably the least important metric to look at when you're thinking about value for your company. Why? Because now you've got to look at what kind of structure it is. Is it a stock purchase versus an asset purchase? Is it all cash up front? Is there an earnout? Is there rollover equity? How long is the transition period for the owners? What's the success rate for the management team that stays? What about the legal side of things? What about the certainty of closing? What about your reputation? What about your legacy? What does it mean for your community that you've been building this company around? And your customers, your vendors, your employees, and literally the town in which this is all happening. How certain is closing versus the risks of getting to the finish line? I can say unequivocally that all of our auction processes that end up with multiple offers, I can't remember the last time our sellers took the highest price, because it was valued on everything else. We have lots of colorful stories on how those conversations go, but valuation, the purchase price, believe it or not, is one of the least important things at the end of the day. It does come down to the confidence of closing, to make sure I've explored all the right options, I have a good valuation, and that the transaction will actually close. If that confidence means more than anything else. If you're sitting there about to sign all the hundreds of pages of legal documents and your hand is shaking, something's not right. Don't close that deal. If, however, you've come in and you've looked at the options, you've run a process, you have a decent valuation, and you've figured out all the softer stuff, you can come in enthusiastically and confidently and say, this is a great transaction for everybody involved, and be happy to sign on the dotted line. So let's think about, okay, your company now is getting ready to think about doing a transaction in the early part of next year. What does it mean? How do I drive value? How can I really think about things? So let's jump into a quick case study that I love to use. Let's assume that same $50 million, 10% revenue growth, 10% margin, EBITDA, valued at 6 times EBITDA. Theoretically worth $30 million today. Not a bad outcome for a motivated seller. But should I wait? Should I sell later? What if I do? Should I get out now or should I wait? Again, it depends. If I wait and just let it run forward, I'm in 3 years from now, that company should theoretically be worth about 40 million, assuming all else being equal. Not a bad outcome by waiting, if that's the objective of the owner. However, without preparation, what happens? Usually there's a retrade. Something's found in due diligence. You're not quite ready. The valuation isn't what quote unquote market would be. And you can expect a 10, 15, 20% discount at the closing table. So realistically, you're going to be about 33 million. Was it worth waiting? Not if you don't prepare. If you prepare, then the opposite is true. Let's say you start managing for value, okay, and you really think about what's driving that outcome. And there's really two ways to do it. Remember that original formula of EBITDA or earnings times a multiple? So if I increase EBITDA by 1% a year, I'm sure that every one of you, the people on this phone call right now, can find somewhere buried in their financials 1% this year and 1% next year. Whether that be a price increase, whether that be rationalizing some vendors, whether that be just paying attention to expenses, 1%, not all that hard. And taking that EBITDA, or that multiple, from a 6 multiple to a 7 multiple. How? Streamlining operations, by improving EBITDA, by having momentum going into the transaction. What's the result of that? Believe it or not, 1% a year and moving the multiple from a 6 to a 7 will add nearly $30 million of enterprise value, nearly twice the valuation by those two very simple metrics. Planning and preparing does make a huge difference. And the more time you have, the better off you're going to be. So that is, believe it or not, how simple sometimes it can be. So let's dive into what really drives value. And I'm sorry for the small eye chart here, but it's the only way we can explain it. So if we look at that basic business, 50 million, 5 million, $6 million valuation, and you say, if I were to grow forward, if we look at the bottom blue line, the base case scenario is that if I ran it without any improvement, just business as usual, be worth $48 million in 5 years from now. The prior chart was 3, this is 5 years. This is how private equity folks were going to look at it. So I'm going to get $48 million for my $30 million business. If I accelerate growth by 10%, meaning I go from 10% and then I'm up 1% the year after that, then I'm up 1.1% the year after that, and really start to accelerate growth, and I change nothing else, then the business could be worth about $56 million. If I take that multiple and go from a 6 multiple to an 8 multiple over that same 5-year period and change nothing else, then it could be worth $64 million. But if I find 1% of EBITDA and I take it from a 10% margin to a 15% margin, just with that one variable alone, not changing anything else, the company would be worth $72 million. If, however, I do all of them, I improve revenue by 10% or 1%, accelerate revenue by 1% a year, I find 1% of EBITDA a year, so I go from 10 to 15%, and I improve the multiple from a 6 to an 8 because you get credit for momentum. If I do all of those 3 things, it could potentially be worth $112 million. So that's the revenue, that's the private equity model, that's the value levers that people look at. Revenue growth, EBITDA growth, multiple expansion. Not too bad. So where do I start? Therein lies the best question of all. First and foremost, build your team. We cannot underestimate the value of a really good, highly trusted, collaborative team of expert advisors. As we like to say, if you're going to sell your business once, do it right the first time. And what does that mean? That means hire the best investment bank, accounting team, wealth team, and legal team you possibly can find. Not all of them are created equal. As we always like to say, a dentist and a brain surgeon are both doctors. They're both really good at what they do. But I would never use a dentist to do brain surgery. So what does that translate to? When you're talking about your legal advisor, Don't use your contract attorney, your divorce attorney, your real estate attorney. Use an M&A professional. When you talk about your accounting team, usually upgrade to a larger firm, a more reputable firm. Get a quality of earnings report done that is specifically tailored for an M&A process. Hire the best tax experts you can to minimize your tax exposure through both structure and some planning. When it comes to your wealth team, think about not what the proceeds of this transaction are, but what does it mean for the next generation and multiple generations after that? How do I look at minimizing taxes, and what am I going to do with all the money at the end of the day? And really look at and do that planning well in advance of doing it. So the best first step that you could possibly take right now is to go get your legal team, get your accounting team, get your wealth management team, and your investment bank all lined up, ready to do the transaction. The more time that group has to work together in advance of a transaction, the better the outcome is at the other side. We cannot overstate the importance of having that really good, trusted, collaborative advisor network of experts. Upgrade, upgrade, upgrade all the way around. Those folks will then pull in that outer circle of other experts that they can rely on for very specific tasks that are going to be important going forward. But as we like to say, and you'll see some articles from us, the core four need to be put in place first, and then those have their spider webs out to other networks of experts. So what do I do now? That's probably your question. At least I hope it is. First and foremost, 6 months prior, if you're going to do a transaction next year, start now. Get your trust and estates plan in place. Think about all the alphabet soup of potential structures. Give low basis stock away using today's valuation of the company, using estate planning techniques, which is valued differently than M&A techniques. Use that to set up your slats, your grats, your IDTs, get trust for the kids, for philanthropic endeavors, for minimizing taxes. If we increase the purchase price by 20 or 30%, that's great. But if Uncle Sam's going to take half when you die, why bother? So think about that tax minimization strategy as you go forward, and really make sure that that structure and that planning's in place. Part and parcel to that is going to be, if you've now converted this illiquid asset of your company now to cash, what are you going to do with it? How are you going to allocate that? What are the dreams and wishes and expectations going forward? How much do I need to live on? Most business owners expense a lot through their businesses, right? They're in a tax minimization strategy, not a value maximization strategy. So now that we don't have the business to wash that through, well, now what? How do I afford that second or third or fourth house? How do I think about vacations and expenses and country clubs and boats? So we have to have that before you embark on this, so that you have the confidence at closing to say, I got the right amount. If you look at other long lead time issues, the environmental, especially for most manufacturing companies, is really important. It's a long lead time item. You don't want any surprises. So 6 months prior to thinking about doing a transaction, go get a phase one. They're really not that expensive, and they have huge dividends on the outset. Clarity and full disclosure are going to be really helpful here, especially when it comes to environmental. Case in point, we did a transaction a couple of years ago where the buyer found some environmental issues, and they wanted a $6 million reduction in purchase price to cover any and all environmental issues. $6 million. Well, we took it upon ourselves. We put the transaction on. We took it upon ourselves. The company did, and for $350,000, remediated the tiny little issue and confirmed there was no future issues. We saved ourselves $6 million. By getting ahead of it and addressing it in advance, it will pay huge dividends on the back end. Go get your environmental phase one. The other big important thing that most owners forget about doing in advance is doing some management incentive planning. Any management team would like to be part of a successful exit and be incentivized to stay with the new owner going forward. That takes some planning. That takes some creative minds. It takes some time to put that in place. Ideally, that's 6 to 12 months prior to transaction, So if you structure it right, at least management teams can get long-term capital gains if it turns out to be an equity grant at today's value. So doing that in advance really helps. It's much easier to do it in advance than it is at the closing table. Most importantly is really think about addressable issues. Everybody has some low-hanging fruit that's there. So go, you know what they are, go fix them. And that value is totally accretive to the company and the management team going forward, and gives you momentum, and you get credit for momentum. At the end of this year, here's the other things you're going to start planning. Upgrade to an audit. It's amazing to me that we can deal with companies with hundreds of millions of dollars of revenue that still have a review, and that doesn't cut it. So upgrade to an audit, get your QOV, a quality of earnings report, up and running, and really stay on top of it. As you go into year end, make sure that you've really thought about working capital. If you can minimize your receivables, minimize your inventory, stretch out your payables. When you do the transaction, they look back 12 months. So if you can start doing that now and managing it, it just leads to an incremental purchase price at the end. And then obviously do all the right accruals and stuff, but you all have that under control. 3 months prior, engage legal counsel. Really start to look at the major line items, the major contracts, the certifications, the licenses, the I-9s, all the different issues that need to be addressed. The more time that is better. 3 months, 6 months is really the right time to do that. Start building your data room. All the major contracts, all the major vendors, all the major financial reports. Start really thinking about building that data room to make the transition smoother. Work that goes into an M&A transaction is fixed. It's the same amount, no matter how much time you allot to it. The earlier you start, the easier it is to manage. Because if you get into a process and you got to do the same amount of work with a short period of time, it just stresses everything out. So we also recommend engaging or re-engaging with really important clients. There will be reference checks to clients and key vendors prior to the closing of the transaction. Get them on your side. Think about how they will espouse your praises as you go forward. Nothing worse than doing a surprise customer visit or a vendor call, either just before closing or just after closing, and an issue is discovered. Discover that prior to ever starting, address that issue, and then you make sure it's smooth going forward. So here's the biggest question of the day. When do I call my friendly investment banker? Anytime you need to educate, explaining the process, developing an exit strategy, understanding what's motivating buyers and sellers, to think about all the different options. Remember the Gantt chart we showed before of minority, majority, refinance, majority equity, LBO, strategic transaction. And a quick reality check. What we find is most owners think their business is worth a lot more than it might be. So let's do a reality check of what the market's going to look at today and make sure that expectations are met going through the transaction. And really, for us, one of the values we can bring is really understanding the key value drivers. Business owners that have been running their companies for 10, 20, 30 years or generations tend to lose value of what the market thinks are value drivers as opposed to what they think are value drivers. And so there's definitely some strategies that can be put in place in advance of a transaction to really maximize that shareholder value and minimize risk. So if we can ever be helpful, or your local investment banker can be helpful, engage them early. Most of us love to have the conversation about how to drive value and how to end a successful transaction. So with that, we made it. We got about 10 minutes left through here to answer any and all questions you might have. Here's my contact information. Please feel free to reach out to me directly, or better yet, channel it through Bruce and the folks over at FENG, and happy to go from there. Bruce, how'd I do?
Ramsey, thank you. That's great. I think that there's some information there that people are going to have to digest. I guess the only suggestion I would make is you do it in small bites.
Work is finite. The amount of work that goes into it is fixed. There's no way to avoid it. There are no shortcuts. And so you're right. How do you eat an elephant? One bite at a time. So small bites in advance will really help through that whole process. Completely agree with that.
Okay, now for those of you who are out there, now is the time to bring forward your questions. And again, please write them into the question box on the lower right-hand side of your screen. And I would imagine that Ramsey will be addressing most of them, but maybe I'll chime in if I have something really intelligent to say. Okay, here's a question here. My company needs extra capital. Do I talk to banks or non-banks? In other words, private equity, direct lending. Any thoughts on that?
Sure. Right now, senior lenders are really challenged. So your traditional bank, your regulated entity, is really challenged. They're dealing with their portfolio companies where the debt capital costs have gone up so much in the increase in interest rate that's gone from 5% to almost 10%. A lot of those, they're focusing internally. They're really challenged to put new money out there to new things. If your requirements are, I'll say, under 2 times EBITDA, I'd say keep going to the bank. It's the cheapest source of capital. At that level, there's no regulatory issues. If you're I would stay with your existing bank. Moving new banks is quite the challenge. And senior lenders right now are really looking for, you ready for this? Deposits. So if you can move more deposits to your existing lender, they will be more accommodative in their lending environment. If you're more highly levered than that, or it's a riskier investment, then yes, you'd have to go to a direct lender, a direct private capital lender. There's plenty of them out there. They love filling the void right now because if you think about it, they've moved up on the food chain and their pricing is still quite robust. And so now they're willing, able, and excited to put capital to work right now. But that cost of capital is still very high, even though they have more security beneath them. If your third tranche, in all reality, is going to be a private equity investor, regardless of a minority investment or a control investment, there's a lot of other implications of now having a partner in your business versus just a lender. So it really, again, I hate to say this is our standard out, but it depends. If it's under 2 times, go to your senior lender, give them more deposits. If it's more than that, try to go to your direct lenders. The private capital markets, they are willing to put out money, but it's going to cost you. And then it depends on what you need for the business. If there's more resources than just capital that you need, then consider your private equity partner.
Okay, here's another question. If I'm looking to sell my company, should I be selling 51% majority? Does that sort of hurt value, or if I sell a minority interest, could that potentially increase value?
That is a great question. Thank you. What we see in the middle market is there's a premium paid for control. So 51, if you had 2 exact same companies doing exactly the same business and looking at the 2 exact same type of investments, and one was 49%, one was 51%, the one at 51% would be worth more. So there is that control premium theoretically. It also, and I think more importantly, opens you up to most private equity folks are control investors, where they want to have or need to have, per their LPs, a majority control of the transaction. What does that actually mean, though? Let's think about what control actually means. Control is a legal obligation at the board level of about 9 different things that the board can then control. And those are, do I want to buy a company? Do I want to sell the company? Do I want to leverage the company? Do I want to make a loan? Do I issue new equity? Do I hire senior management? Do I fire senior management? And or do I materially change the outcome of the business? Those are really big strategic decisions that is defined as control. Rarely will a private equity investor make those big decisions without the input and advice of the person who's been running it for 30 or 40 years that has gotten them to this point. Remember, most investors are just that, investors, not operators. So most of the time, that control investment is only at the board level. It does not affect the day-to-day operations, so that you can still run your business as you've been running it day to day, making all the strategic decisions. The control of 49 versus 51 is only at that board level, and rarely, by going to control, it opens up more options, it gives you more value, and probably gets you a better partner. Minority equity investments is a little bit of a mythical unicorn. Even if you were to do a minority transaction, i.e. a non-control investor, they have what they call negative covenants, where you can't do those 9 things I just mentioned without their permission. So what's the difference? It's very negligible. So if you want a higher value with a better partner with more options, consider a controlled transaction.
Okay. Here's another question. Again, I'm looking to sell my company. Who's going to give me the better value, a strategic buyer or a private equity firm?
I love this question. Again, great question. And you're going to hate my answer. It depends. It depends on the type of partnership you're looking for. What you want to find is the right, and we try not to say buyer or investor, right? Because those are binary terms. What we try to say and try to focus on with all of our clients is looking at who's the best partner for the company going forward. Who shares your vision of what's happening next? Who's going to give you the resources and the access you need to make that vision a reality? It depends. Valuation is in the eye of the beholder. For theoretically, in the upper middle markets and the mega markets, strategic buyers will be able to pay more because of cost synergies. That may be true, and that's what you hear about the Wall Street Journal, and that's what you see on Bloomberg, is the big mega mergers where you're shutting down factories to save money. That's how you drive that last dollar return. In the middle market, it's driven by growth. Remember that model we just were reviewing, that 1% EBITDA growth and that little bit of excess acceleration of revenue growth. That's what's driving valuation. So it's not about cost savings. So theoretically, in the bigger markets, strategic buyers should be able to pay more than financial buyers. In the middle market, we found actually the opposite, that most middle market companies don't have the scale to attract the larger strategic buyers. There might be some good middle market buyers. There might be some private equity portfolio companies that are strategic. But we've seen recently that the financial buyers actually have been valuing growth opportunities more than big strategic buyers. So I hate to say it, it depends on your vision for the future and who the right partner is going forward.
All right, thank you.
These are great questions, by the way.
We're approaching that magic sort of 1 hour mark, but I think we've got time for one more question here. Which is better for me to do? Should I be increasing sales or increasing margins as I prepare to sell?
So 2 ways to answer that. Mathematically, you're probably better off focusing on margins. As I say that, my guess is some of my partners back in the office would say the opposite. But I think that mathematically, by increasing that EBITDA just by 1% a year, really drives that. It drives valuation a lot more. Multiples are driven more by, in the middle market, old economy, family-run businesses, are driven more by EBITDA growth than they are by revenue growth. If you're looking at venture capital or some of the fintech or some of the healthcare things, that's probably more appropriate to focus on revenue growth than it is margin. But in traditional businesses, margin is king. A 10% EBITDA business is a good business in manufacturing, for example. A 15% margin business is a spectacular manufacturing business. And so focusing on just a little bit of tweaking around the edges on margin will probably drive valuation higher than that incremental sale without much margin improvement.
All right, well, great. And magically, we have sort of made the 1 hour mark. Ramsey, thank you very much. I think that the amount of information you put out here is, again, going to take people a little time to digest, but
it's a lot.
As you said, yeah, I don't, selling your company tomorrow is a bad idea. So they have the time to think about it. And again, the year is not over. So, all right, with that,
now is the time to plan and prepare and really lay the foundation for something coming up next year. When the market, so you need three things to be successful. You need the company to be ready, which is what we're talking about today. You need the markets to be ready, which is will be coming back fairly quickly. And then you need the owners to be ready. And what we're seeing is most owners are getting ready. So that triumvirate going into next year should be fairly robust. Now's the time to plan and prepare, get the company ready.
Great. Well, thank you very much. And for those of you who will come up with questions as soon as I end this webinar, not to fear, just send me an email, and I'm sure Ramsey will be in touch very shortly.
Would be happy to. Bruce, so thank you very much. And thank you everybody else for attending and listening to me ramble on here for an hour.
I will thank you very much. And thanks everybody for attending, and we'll talk again, I'm sure. And with that, I'm going to shut down the webinar. Thank you all for attending.